Hi everyone, I'm the Tax Pro, and today I'm going to talk about the equity section of the chart of accounts in QuickBooks Desktop. So we've already talked about the importance of the chart of accounts in other videos, and now I'm going to cover the equity section specifically. This is QuickBooks Desktop. In order to navigate to the chart of accounts, you're going to come up here to Company, go all the way down to Chart of Accounts. You click on this, your chart of accounts will pop up. If you are running the accountant version, you can also go to the accountant menu and click chart of accounts. Now there's already some equity accounts in here. QuickBooks Desktop did that when I set the company up. So when you set a company up in QuickBooks Desktop, it asks you how the business is taxed. And based on that answer, it is going to set you up some equity accounts. We are potentially going to modify those equity accounts a little bit. In order to understand what equity accounts you do need to understand how you're taxed. So the options here are sole proprietorship, which is one owner. It can either not have a legal formation or it can be formed as something like an LLC. By default, that is taxed as a sole proprietorship. If you file a Schedule C, you're a sole proprietorship. Partnerships have two or more owners. It can be legally formed as an LLC, or it doesn't have to have a legal formation. By default, that's a partnership. It files a Form 1065. C corporations are generally corporations on the state level. That's the default for those is a C corporation. They file Form 1120. Now you can also elect to have other legal structures taxed as a C corporation. So if you have an LLC, technically you can have it taxed as a C corporation if you elect to do so. An S corporation is a tax election that can be made on any legal entity as long as it has some sort of formal legal formation and the company meets all the other requirements of an S corp, such as number of shareholders, etc. That files Form 1120S. So I'm going to show you those four different structures here for equity. Okay, I'm going to start with an S corporation because it's kind of already set up here. An S corporation is going to have capital stock. Okay, and real quick, I just want to show you our options for equity account types. It's just right here is equity. Okay, there's no other account types here that you can possibly set up. So to create an equity account, you would go in, click account, new, hit equity, continue, and then you would name that account. Okay, so capital stock is the stock in a corporation. So an S corporation is going to have a capital stock or a common stock account. So oftentimes this will say common stock. S corporations cannot have more than one share or one type of stock, one class of stock. So if there's capital stock, you can't have like capital stock and common stock. There can only be one type of stock. So this defaults to capital stock. You might want to just rename it to common stock, which you can do like that. Save and close. Opening balance equity is an account that QuickBooks utilizes. There should not be a balance in this by the time you are done adjusting things out, but QuickBooks will put it in there, and that's okay. You can leave it in there as long as there doesn't end up being a balance once you have set your QuickBooks accounts up completely. I will have a whole entire separate video on opening balance equity because it's a big issue that I see clients run into all the time when they're trying to do their own books and that accountants and bookkeepers have. Retained earnings is going to be an S Corp and a C Corp account. Retained earnings is an account that is essentially where prior year earnings go to. So prior year earnings go here, and then shareholder distributions will also be closed into that account. Shareholder distributions is the account in the S Corp where money is taken out of an S corporation and paid to the shareholders. These are like dividends for S corporations. Okay, so that's the S corp equity setup. Now let's talk about C corporations because we're going to use some of these same accounts. C corporations will have common stock. You may also have a different type of stock. So if you have more than one class of stock, you may end up finding that you have preferred stock. You want to make an account for that other type of stock as well. You may also have like additional paid in capital in the equity section as well. But you for sure need a stock account. Again, opening balance equity can stay there. You do need a retained earnings. It plays the same role in a C corporation as it does in an S corp. So retained earnings is where prior year earnings get closed to. Shareholder distributions, on the other hand, is going to be dividends. So we call them dividends in C corporations. So this is your setup for your C corporation. You should have at least one type of stock account. You should have a dividend account. Opening balance equity can be there, but there should be a $0 balance in it. And you should have retained earnings. You may have other types in here as well, but this is your basic C corporation setup. Okay, now let's talk about sole proprietorships. So for sole proprietorships, common stock is not, it's not an account. So I'm gonna change this and I'm gonna do owner's equity. You could also call it like owner's contribution. This is essentially the amount of money that the owner of the sole proprietor puts into the business. Okay, so owner's equity is the money that the sole proprietor is going to put into the business. Dividends are going to be owner's draw. So this is the money that the owner pulls out of the business. So you're going to have an equity account for the money that they put in the business, a draw account for the money being pulled out of the business. Opening balance equity is going to be here all the time because it is a QuickBooks account. Retained earnings is what QuickBooks uses to essentially put money into equity. So retained earnings can stay here. It's not technically a equity account that we traditionally see in a sole proprietorship, but it's okay, it can live here. It's gonna stay here because QuickBooks uses that account as a retained earnings account. Now you can delete retained earnings if you really want to, and then in that event, the income would flow into the owner's equity account. So you can treat it traditionally like a sole proprietorship. I know a lot of people like to have that retained earnings. Traditionally, it goes into the owner's draw account. Okay, so that's sole proprietorship. Partnerships are going to look very, very similar. The only difference with partnerships is each partner is going to have their own draw and their own equity account. So let's say that we have a partnership with Susie and Bill. Susie is going to have her own equity account. This is an account for the money that Susie specifically puts into the business. On the same token, Bill is going to have his own owner's equity account. So that is for the money that Bill puts in the business. So we have owner's equity for Susie and Bill. And each of these guys is also going to have their own draw account. And you would do this for each partner. So each partner has a draw account. That's for the money that gets paid to them. Each owner is also going to have an owner's equity account. Retained earnings, again, can stay here if you would like. You can close all of the profit accounts and the expense accounts into it. And then from there, in a partnership, that needs to be divvied up into each partner's equity account based on their share of earnings. So if Bill and Susie each get 50% of the income or the loss from the business, then you would take retained earnings at the end of the year and you would split it between Susie and Bill. So that is the equity account for partnerships. I hope that was helpful. If you guys have any questions, please let me know. Otherwise, I will see you guys in the next video.